Good afternoon, everyone. We will start the webinar in roughly a minute. For those who are joining now, we will start the webinar in roughly a minute. The webinar will start soon. Good afternoon. Well, for those in Europe, good morning on the west of Europe, and good evening or good night eastern of Europe. Welcome to this webinar. I browsed through the registrations and I see a lot of asset owner representatives, both pension fund board members and executives, asset managers, equity portfolio managers and analysts, private equity fund managers, venture cap fund managers, the associations of private equity, consultants, even compliance officers. The topic is clearly hot and of interest to many. A special welcome to participants who are member of the International Center for Pension Management, ICPM. This webinar is part of a series of online events ICPM offers as our short-term response to the COVID crisis. My name is Rob Bauer. I'm the Executive Director of ICPM, but also Professor of Finance at Maastricht University, and I moderate this webinar. Today, Professor Ludovic Phalippou of Saïd Business School in Oxford, who's a well-known researcher in the field of private equity investments, will be our guest. And before I introduce him briefly, just a few words on how we organize this webinar. Professor Phalippou will present for about 25 minutes, after which the online audience can ask questions for the half hour after that. Please use the Q&A function on your screen to put forward your question. And as a moderator, I will select some of these questions and read them out. You can send questions to me anytime and directly from the start of the webinar. So it's clear everyone stays muted and there will not be videos. I'm sure you will understand that not every question posed can be actually asked in this hour. However, if you want to follow up with Professor Phalippou after the webinar, feel free to send an email to ICPM or contact him directly. And also, please respond to the short survey at the end of this webinar. It will be sent immediately after. We really value your feedback. Let me now briefly introduce Professor Phalippou, who is a professor of financial economics and head of the Finance, Accounting and Management Economics Group, University of Oxford, Saïd Business School. So today he will present a fresh research paper. It has not even been published. It's not on SSRN. We cannot find it anywhere. It's just this presentation. So we're really happy that he's willing to present it here. The title is also catchy, An Inconvenient Fact, Private Equity Returns and the Billionaire Factory. So thanks for this, Ludovic. Please start your presentation. I will stop mine so that we can start.
Thank you very much for the introduction, Rob. My pleasure to be here and to tell you about what indeed is my very latest research paper. I want to start with some macro view of the world of investing. And I'm going to start with 20th century investing. So what is 20th century investing? It was basically, once upon a time, we were investing in companies that were roughly split 80% equity and 20% debt. The equity was publicly listed, the debt was a bit publicly listed and some privately held, and it was all basically also financed by pension funds and others. And economists spent a lot of time in the 20th century, financial economists, to try to understand the cost of this financial intermediation. And financial intermediation means you have people with savings like pension funds and they need to invest into companies. And on the way, there are some people who are facilitating this channeling these are financial intermediaries, and how much does it cost for money to go from the saver to the production, right? That's the cost of financial intermediation. And economists find out that it was pretty expensive. So they found out that when you have this public equity, you need to start with an initial public offering. This equity needs to come to the public markets, and that's 7% of the value of the equity, which is punchy. And economists complained a lot about that and puzzled a lot over that number. On the other hand, this 7% is amortized over many years. And you do have some costs if you do some extra equity offerings, like season equity offerings, but it's less than 7%. You do have some extra costs, like transaction costs, all kinds of like price impact, rebalancing, etc. And there again, there's been thousands of papers. And it was expensive, okay? We puzzled over the cost of that, but it was probably like 1% a year or something like that. Then, of course, the debt you had to pay for the issuance of this debt for a company and to go all the way to the pension fund. And that was maybe like 2% plus transaction cost. And then there was some other financial intermediation, but relatively minor. And as I said, the economists were puzzled about this. They found it very expensive financial intermediation. They thought like the financial sectors looks a bit too big, like to channel the money from pension funds to the real assets. It seems a bit expensive. And they wrote a lot of papers to document that, with perhaps the consequence that it has put a lot of pressures on this cost. And there is this rise that we have observed that I do not want to call passive investing because it isn't. What has risen is the low cost, transparent vehicles to invest your money. That's what has gone up. And regulation has gone up tremendously. So again, as part of his work in financial economics, people have kept on documenting that there were some conflicts of interest, that these financial intermediaries in instances were taking money to them instead of to the client. And so the SEC usually picked up on all this academic research to change the rules to try to avoid, almost each regulation was to avoid the financial intermediary directing money to his or her benefits instead of that of a client. And this is how this evolved. But then in the 21st century, we kind of gave up on this altogether, and we moved to the world of private. So basically in the 21st century, before we go through his numbers, they're non-trivial, so bear with me. In the 21st century, we decide to go to private equity. And to give you like some ballpark numbers for pension funds, and even though these numbers are always a bit hard to exactly calculate, but in the 90s, the pension fund was like 60% public equity, 40% fixed income of different kinds. The 60% of public equity became 30% of public equity and 30% of what is private equity. And it's not just a leveraged buyout, or corporate leveraged buyout, but it's like leveraged buyout of infrastructure, leveraged buyout of real estate, and all these things, which are private equity. So basically now pension funds are like about half-half, as much in public equity as in private equity in aggregate. Again, private equity widely defined. And the 40% of fixed income is there, but also has been replaced a bit by private debt, that is the debt coming from LBOs and so on. So basically a lot of the money has moved to this private world. Now, what's the cost of this financial intermediation? So these numbers are back of the envelope calculations, macro numbers, but they can roughly coincide with reality of the statistics we know. So basically in any given year, we know that there is $200 billion that is invested in LBOs. Again, it can be an LBO for real estate or an infrastructure asset. It's a leveraged buyout. It's something that is financed 2/3 with debt, 1/3 with equity. So 200 billion goes to the equity and 400 billion goes to the debt. There's 600 billion of assets being bought. And this 600 billion coincide with 60 billion of earnings, the earnings being 10 times less than the enterprise value, okay? And when you have 200 billion of equity and 400 billion of debt, with the increase of this value on average in a given portfolio, that coincides with this $1 trillion of assets under management that the private equity industry has. So what's the cost? When you acquire 600 billions of assets, it costs 3% to acquire them. This is the due diligence, the legal cost, all kinds of charges by GPs, etc. It can be 2.5, it can be 3 of direct costs, and then you have all kinds of over costs. Taking over a company costs a lot of money. There's tons of due diligence, tons of legal work, tons of accountants working on this, etc. At 3.3% of enterprise value, we are talking about $20 billion a year that goes for these acquisitions. And then you are borrowing money. You are borrowing $400 billion. How much does that cost? 2.45%. It depends on the vehicle you're using, but basically it's around that number on average across vehicles. There's not that big a discrepancy. So it's 10 billion. Now, the money needs to be channeled to the asset. So this equity needs to go from the pension fund into the asset, and the debt also comes from pension funds. It's not the banks who are giving 400 billion a year of loans. These 400 billions come primarily from pension funds, whether they do it via buying collateralized debt obligations to the banks, or whether they buy stakes into private debt funds who then deploy this money. How much does it cost to channel the debt? This is probably the number where we have the least idea about, because you need to know the fraction of you need to know the market share of private debt funds versus the banks versus other vehicles. And the private funds, we know roughly how much they charge. There's differences across funds, but it is not far from like 1% plus a year, plus sometimes some carried interest. So you need to have a lot more information than we have. I took 5%. The idea is like, it's really a lower bound. So channeling the money from the pension funds to these investments is 5%. Again, you have to think about it like it's for a 4 years investment. So every year you need to pay an amount to have channeled that money there, right? So that's the accumulated amount. So that would make it another 20 billion. And the cost of equity provision is, what is the cost of these private equity funds? It turns out that in the late 1990s, Gompers and Learners had said that it's about 1/3 of the equity channel that goes into costs. It turns out that their number is very close to everything that we have found out thereafter, all the way to today, as we got more and more data. So I don't take 1/3 or 30%, I take 25% as a lower bound. And in this paper, I have access to quite a number of data, and I make a number of simulations to show it's kind of like above that number. But 25% is a good lower bound. So it's 50 billion. So if you add up all these things, what we are talking about is $100 billion of financial intermediation. Now, if financial economists were already a bit uncomfortable with the 20th century cost of financial intermediation, that's quite another dimension, okay, another level. To put it in perspective, we are talking about companies that are earning 60 billion of earnings a year together, right? And we need to pay 100 billion. It's over 4 years, so it's not just on 60 billion, but it's over 4 years. These earnings are going to grow, and 100 billion in fees needs to be taken. I gave this question recently to my students. I made them guess how many people worked in private equity. So unfortunately here you kind of have the answer, but it's an interesting quiz. It turns out that nowadays we have LinkedIn, and you can do these filters. You could look on LinkedIn, how many people in the world, in any country, works in the industry PVC. So it's not just leveraged buyout, but also VC, and there are some aspiring people and not necessarily people working in that, but roughly most of the people working in private equity on LinkedIn. And so it shouldn't be like it should be a pretty good proxy. The answer is 275,000 right now on LinkedIn have as an industry PVC, 275,000 people in the world. The right number, if you look only at leverage buyout, which is what I'm doing here, 100,000 would be the lower bound, 200,000 probably the upper bound. And if you look at how much money I said was channeled and the number of people that it needs to feed, that seems to add up, because 100,000 to 200,000 people is between $500,000 to $1 million a year per person, given the overhead, and these are investment professionals. This is squaring up. So we are basically taking out of companies 100 billion of expenses, fees, etc., to pay the lawyers, accountants, like people on this call, myself, some of it, because when I talk at a conference of the industry, I'm getting part of this pot as a speaker fee, etc. So this entire industry is fed from that pot of money, from 100 billion that is taken from these earnings of these companies. Okay, and it may be worth it. Okay, but we need to bear that in mind. Magnitudes, aggregate. So the interesting question is, how much does companies' earnings need to grow to just like break even if you have to pay 100 billion? The answer is, there are some calculations here, and you can do them later. They're not like immediate for most people. So the answer is that it needs to grow at 11% a year. The earnings need to grow at 11% a year for this 100 billion to enable you to break even with public equity. 11% is organic growth. So you may say, you know, I've seen private equity firms growing companies at 11% a year. This is typically mainly inorganic growth. It's like add-on acquisition. So of course the earnings are growing. But in here it needs to be organic growth. Organically it needs to grow at 11%, which seems to be like super punchy. Hence the conclusion that this model is unlikely to fly as it is devised. Now this is kind of theory based on the macro numbers that are very much adding up. What happened in the past? Did it fly or didn't it fly? The answer is, it did fly. It broke even, exactly. So the private equity returns after fees are basically exactly matching public market returns. So the 100 billion were covered by the increase in earnings. Now this increase in earnings, they're not the only thing that happened. There was also an expansion of multiples. Over the last 10 and 20 years, multiples have increased, which means that you didn't need 11% growth in earnings because multiples were going up. So you needed less increase in earnings. It is also the case that other companies have grown earnings over this time period. And so we don't know here if private equity did better or worse in terms of earnings growth, whether it's skill, luck, we don't know any of that. But what we know is that the combination of the increase in multiples and the organic growth has enabled to break even and to pay the 100 billion. So the interesting question will be, going forward, do we really think that what happened over the last 20 years in terms of expansions of multiples and earnings growth can be repeated? If you think not, these fees are mostly fixed, so it will tell you that it's not going to fly. If you think yes, then it's fine, it's going to fly. Okay. Before I detail the data on private equity performance, because you might not have heard the same takeaway from other people, that you have heard that they have outperformed public equity. Notice that if somebody says that they outperformed public equity, they would need to explain, you know, what kind of growth was behind to manage to cover more than 100 billion, right? So it's quite extraordinary if after all these fees, they would have outperformed. But, you know, some people do argue that, and we'll come to that point. Before we go to the outperformance or equal performance of public equity, we need to define what public equity we are talking about, because there is a way to choose the public equity you want to be compared to. So there are basically two free takeaways that are key here. First of all, if you look at 2006 to 2019, you see that basically all of the stock indices here and mutual funds, etc., have the same returns. The S&P 500, the CRIS value weighted, the Pharma French largest decile, the all Pharma French stock index, mutual funds like T. Rowe Price small cap, DFA small cap, Pharma French, all stocks except large deciles, they all have roughly the same returns. T. Rowe Price a bit higher, but there are two guys who are below everyone: MSCI World and Russell 2000. It might be a coincidence, but this turns out to be the two indices that private equity is most often compared to since 2006. Russell 2000 and MSCI World. And notice how these two indices have different returns from about everything else. MSCI World comes from the fact that emerging markets did a bit less well, but particularly the strengthening of the US dollar means that other markets, stock markets compared to the US, have done less well. Now, that's an important point, which I'm going to come back to. And Russell 2000 in the old days looks like it's a matter of like how they had constructed the index. There was a lot of rebalancing, etc. There are a number of theories about why Russell 2000 has always underperformed in the mid-cap space about any other indices. In 96 to 2009, so prior basically to the financial crisis, there was another difference. Every index in the top of my table at 7-8% return. That's MSCI World, that's Pharma French, that's CRISP, that's Vanguard, everybody's like 7-8%. But the small cap were all at 11%. In a nutshell, in the US, stocks have always had basically 11% returns, small caps, most of the stocks. One exception is the very large cap in the 90s, early 2000s. And globally, the outside of the US stock market has done less well in both periods. Once you understand that, you will understand everything you see about private equity returns and discrepancies. Because it will all come from a benchmark and not because of private equity returns themselves. Summary. Only the largest stock decides to perform badly before the financial crisis of 2008. Therefore, all value-weighted indices did bad, and that's why this so-called smart beta picked up. And smart beta is nothing other than like not value-weighting stocks. That's all it is. Okay. And so any smart beta product in the past had done well up until the crisis because they were doing better than value-weighted indices for the reason I've just shown you. So now here is a practical case for you. Every pension fund, endowment, etc., that you will meet will say, I have much better returns in private equity than in public equity. I don't know what you're talking about. This is a table from an asset owner. Private equity, public equity. Private equity, way above public equity at any horizon. First of all, let's always ignore anything below 10 years in private equity, okay? Let's just look at 10, 15, and 20 and leave it to that. 3 and 5 is pointless. And I think everybody agrees with that. So let's not like get our mind focused on like 2 out of 3 or, you know, let's just look at 10 years. Public equity did less well than private equity. Why? One possibility is that most of private equity is US equity. This 14% you see here is the 14% you see in my third column there. The 14% of private equity is the same as US public equity. And most of its private equity is US mid-cap public equity. Equity is US mid-cap equity. Why is public equity then so low? That's the puzzle. It's not that private equity is so high. It's why is public equity so low compared to the indices I've just shown you? The answer is because they are globally invested. You have no pension fund, endowment, etc., that invest only in US equity. They invest globally. Therefore, their public equity returns look more like MSCI World because they're invested in the world. But their private equity portfolio is mainly invested in the US. So their private equity portfolio is doing as well as US stocks. But if I just report public equity versus private equity, it's not going to be the same. Public equity is going to look lower because it's closer to MSCI World. And here is data from Cambridge Associates, Burgess, Prequin that will be in that paper. And that shows that no matter how you look at it, you get always the same story, which is the vintages up to 2005 did outperform the S&P 500, like you've seen in the academic papers, but only if you use a large stock index, because large stocks underperform everything else. If you use a small cap, mid cap index, or a mutual fund in that space, you will be 1-to-1 basically between private equity and public equity, even before 2005. After 2006, the large and small stocks in the US have the same returns, So then it doesn't matter if you use the S&P 500 or any index you want, except for Russell 2000, you will find that public and private equity are 1-to-1. Okay, but if you use MSCI World or Russell 2000, you will find outperformance, strong one. Now, so it's not bad, the performance. I don't think it's amazing, but it's not bad. It matches. Public equity and private equity match. All right. But what happened is the way you compensate people is not based on relative performance, it's on absolute performance. And the stock market has gone up a lot over this time period. The funds I've just shown you that match exactly the returns of any US stock indices. So from 2006 vintage to 2015. These funds have collected 1.3 trillion in total. 70% of them are in the carry. If you take leverage buyouts, only 77% of funds in the carry. That means that in leverage buyouts, even the bottom quartile funds is in the carry. So it's earning a carried interest, the bottom quartile fund, when already the average is like the public market. And the total that has been charged is $230 billion. So think about that. It's 10 years giving $230 billion for that performance. This money went from these companies or the pension funds to private equity fund managers, and it's very concentrated into the large private equity fund leverage buyout shops, and within these firms, very concentrated in the senior members, usually the founders and the like. So it's quite a large amount of money that has been channeled as a response of this great performance in absolute, not relative. And what it has led to is the billionaire factory that is in the title. I've looked in Forbes ranking in 2005. So before that, there was 3 billion multi-billionaire in private equity industry, and private equity like leverage buyout only, like not real estate, etc. Just leverage buyout. 3 in 2005. Last year there was 17 multi-billionaires, so more than $2 billion of wealth. And a number of billionaires are missed by Forbes because a number of people have big stakes in privately held firms, and it's not easy to calculate how much they are worth. Another interesting data point is that if you take, you shouldn't, as you know, you should never look at an IR. The only thing you can look at is a multiple of money, basically, to know where people are roughly in terms of money they've made. And you have 5 pension funds that are kind enough to put on their website all the data you need to calculate their multiple of money, meaning something as simple as how much did they give in private equity and how much did they get back. What is amazing is that all of these pension funds have the same number, 1.5. And when I do reviews of pension funds, I always find that number. It seems to be like a magic number. Everybody's like, you say, how much did you get in private equity? Is like 1.5 multiple. And 1.5 multiple coincides with 11% a year return because things are held for about 4.5 years. So it's actually a bit less than 11% a year, which happens to be the stock market returns. And these multiples also coincide with the averages I've shown you earlier, which means again that we know that these multiples coincide with a PME that is actually slightly below listed equity. I'll go quickly on that because I still need to double check some numbers there, but even the big 4, they report only their gross of fees multiple of money, and that's about 1.8. And again, in my experience, whenever I hear about the big names in the industry, their multiple of money, gross of fees is usually about 2 times, 1.9 times. And if you want to go to net, here I subtracted only the carry because it's very hard to subtract also management fees. It's quite a big guess. So just net of carry, I found that their multiple is already at 1.6, which is not far from the average. Which would mean that the big 4 that people think are like, you know, these big guys because they have this amazing track record, it looks like the track record is good, but we don't know it if we don't have a proof from their data, but like net of fees, it would be like particularly special. What is it people don't get? I think it's IR. I think it's IR for a lot of it. This is from Apollo, opening up saying we generated 39% IR since inception, like over 30 years period. This is KKR in their filings, the latest one, saying we have 26% since inception. And if they even go to the point of where they compare an IR to stock market return, which you cannot do. And they even go to the point where they compare an IR gross of fees with a stock market index gross of fees, which is quite punchy as a statement. And as it turns out, you know that IR is bullshit, and hopefully. And it turns out that I had written this paper showing that Yale IR was never changing from one year to the other. I was like showing that this was like a completely empty number. And with KKR, what's interesting is that you can go to their filings every year since they've been listed. And since they've been listed in 2006, their IR that they report is 26%. Every year KKR tells you that their performance is 26% since inception. And this is like since the 2008 crisis. And it turns out that 26% is the IR of their legacy funds, the funds they raised until 96. So it means it has been 30 years that KKR has 26% since inception returns. And in 100 years' time, they will still have 26% return a year. So IR is really bad, is absolutely terrible. And it's amazing that people just don't get that point. The 39% of Apollo, if people had just given 100 million in 1990, and that would have compounded at 39%, today it would be worth $2.3 trillion, okay? Nobody has $2.3 trillion. So it's clearly a very, very big problem. What else people get wrong? I'm happy to go into the details of that, but I think there's a lot of conflicts of interest. We are all conflicted. When you work in an industry, if your wage, living, future career opportunities are dependent on you not understanding something, you'll make sure you don't understand it. And if you don't believe in it, then you don't do that job. So if someone doesn't believe in God, is very unlikely to be a priest, very unlikely, okay? So if you do not believe the private equity model, the usual marketing spin, etc., it's very unlikely that you're going to spend 20 years of your life in the private equity industry. So you need to recognize also the self-selection, just like my own bias is that if I've chosen to be an academic, is that I'm going to be very skeptical about anybody telling me they have an alpha. Because if I believe there was an alpha, I would go out there and try and get it, okay? So being an academic, I will have also a natural bias. I'd be self-selecting in a category of people who think that everything is way too expensive, makes no sense, and there is no such thing as an alpha, okay? So there is this interesting quote that I don't know if you have really time to read, but I think you can see the slides later or at your own pace. This quote is from no other than David Swensen 20 years ago, basically telling you exactly what I've just been covering here, that the fees are such that it cannot fly, and that on average, the fund performance is not very good, or at least it's not like extraordinary. Okay, again, I didn't say it was a catastrophe. It's just not something like to write home about. We can go through the review tools if you want. Key takeaway, what you just saw was a set of facts. The multiples of money, the PMEs, these are facts. You can replicate them all. You can cut and dice the data the way you want. You can just replicate all these facts. These are facts. These are not interpretations. These are data points that can be checked. I didn't break it down by different approaches, fund size, strategies. There are all kinds of nuances. You have some fund managers that charge less fees. You have some fund managers that have less conflicts of interest than others, that are more ethical than others. You have people working on different geographies. You have people working in different size brackets. For smaller funds, it's very hard to cover all these costs with the management fees they charge. For large funds, it's a lot easier, and it becomes a rent, etc. The billionaires, I mean, in the large fund, not in the small funds. You have all kinds of nuances like this. I've presented a macro view of the industry to compare like the 20th century with the 21st century, to think about like the future, what would make more sense. I didn't give you an interpretation of the facts. I just lined up facts. It can be interpreted in different ways. One can say, I think the right benchmark is MSCI World, and they outperformed, and I'm cool with that. It's fine, but then becomes an interpretation that is still coherent with facts. So basically, at least what I did prove is that it's not really trivial to conclude on the past performance and the expected performance of this asset class. And the same way that people tell me, look, I can disagree with a number of possible interpretation of your facts, then I would say it's fine, but it just shows one thing, that what you see on the marketing brochures doesn't have this obvious interpretation that the asset class has done amazingly well and will do amazingly well. There are plenty of reasons to be skeptical of the statement and to be careful about that statement. I'm not saying that the future is necessarily going to be bad overall for a subset of assets, etc. I'm just saying that the usual marketing spin you hear by consultants and many other people who might not be the most objective people given their incentives doesn't seem to really line up with the sorts of doubts you would have from like looking at the data in a cold way, like I've fortunately laid out. I also think the storm is coming. For a long time, I was ostracized as like the guy who thought he couldn't add up and the guy who was misleading, what was misled, or papers after papers, especially this year, came out with the same numbers I've shown you. Even George Lerner wrote a book with Victoria Ivashina in which they just did the maths. They just got new data from State Street. They looked at it. They got the same numbers as I did here, and they just say it. It was in the Bain Company report this year, of the annual report, that in terms of returns the last 10 years, we didn't see any delta. And so there are already many investors and fund managers that are developed different models, different approaches to make it less costly, to better align interests, to work on the fees, etc. I think this is correct. They're on the right path, but they are a minority. And I think that it is best, to encourage them and to help them, and for that to acknowledge the facts rather than trying to just say, there is a weirdo that is putting these facts together, but I don't know, I guess it's wrong, right? As I said, maybe in some comments here, this is actually going to be my last paper on performance. I've been working for 15 years. It started when I looked at I was one of the first academics fortunate enough to see fundraising prospectuses back in 2004 and 2003. And I couldn't believe my eyes. I couldn't believe how misleading they were. I couldn't believe the footnotes I was reading. And I always then thought that this just couldn't fly. This was not possible. And I spent 15 years trying to show the misleading information that I saw, and trying to do the data and doing the maths the best I could, etc., to document things. But there is this important law of physics, which brings me to an end on this research agenda, and I'm going to move on to another one. And it is that the amount of energy required to combat a unit of BS increases exponentially with the amount of energy used to generate that unit of BS. And so if you have 100,000 people out there that want to generate BS, it's going to be like really, really tiring. Okay. So this will be my last paper. I put up the facts and I will leave it to that. And people do whatever they want. I don't care. I have no vested interest in one way or the other. To illustrate this important law of physics, you can imagine one person sending one tweet saying, use chloroquine and that will cure your disease. That takes 1 minute to generate that BS. It's not completely wrong, but that's why it doesn't take a minute to eliminate it. It's not totally stupid, because it could be that this particular medical pill eliminates the disease, but it's not obvious. It would take months of trials and tests and so on to really prove whether it's true or not. And so that illustrates perfectly the law. 1 minute to generate the BS, but months to prove it wrong. I just want to conclude by saying, if you want to hear more, I released the second version of my book. This is all the details. It is technically a textbook as well, so I have slides and so on that I will post, and all kinds of material for teachers who wants to use it. You can follow me on LinkedIn and a bit on Twitter. I mainly post things on LinkedIn. And there is a new online course that I have launched on private markets investing. It's not just my voice. There are 50 practitioners giving their viewpoints and so on. It's an amazing course, and it's going to be launched in late August. So check it out if you're interested.
Thanks, Ludovic. Fascinating, thought-provoking, and lots of questions asked in the Q&A chat function. And that is logical because there are a lot of people in this, as I said, heterogeneous group of people that will have different perspectives on what you just said. So maybe before I go to the detailed questions that I have been asked, there must have been some rebuttals, not just on your previous paper, but even on this paper, and thoughts that you have probably shared somewhere else as well. So what would David Svensson say today, and what do the KKRs of this world say when you give this story? Can you give us some insights on that?
Yeah, so KKR hasn't responded, but I was pretty fortunate that Blackstone sent a very long reply, and I'm asking them whether I can publish their reply in full. They sent a 5 pages rebuttal, and I would like to put it in the paper so that people can read what the leader, that's the largest private market firm in the world, would respond to what I've just shown. Mm-hmm. Basically, it's quite long. I'll give it to you in a nutshell. There are things about it. It's a lot about benchmarking. So there is no rejection of the facts that I've just shown you. It's about the interpretation. And like I said, the interpretation then is fine, but you will need to still be coherent. So for example, they say when you do private equity here, you have mixed different things together. We do, for example, a lot more real estate and a lot of energy, and energy has done very badly after 2006. Real estate as well did less well than the stock market. And therefore, if you would compare the sub-asset classes of ours with like private equity REITs, with energy indices, we would do a lot better than what it looks when you pull everything together. That's fine. One can do that. That shows the difficulties of benchmarking. You can do that as a benchmarking exercise, but it then means that you want to not give credits either when a private equity fund is choosing the right industry, right? So if you say, it's not down to them to choose the industry. So if they choose the wrong industry, it's not their fault. Like they chose energy and that went down. So that's it. It should be compared to other energy things. Fair enough. But that means if they choose the right industry, they cannot be credited for that either. So it needs to be coherent. But if people are, one can say that. One can say, look, within the industry I've invested, I did relatively well. It's just I chose some bad industries like energy, and that was bad luck. So that's fine. They said their NAVs are conservative. That's a bit at odds with academic evidence, but you know, that's one argument. I acknowledged in the text, they emphasized it. I didn't talk about diversification benefits. So as you know from Finance 101, even if something gives you as much return as the public market, if the correlation is less than 100%, you should definitely invest in that asset for the diversification benefits. That's fair enough. I just don't know how to measure diversification benefits. When we try in many papers, it looks more like a 90% plus correlation really when you try to correct for all the biases. So there is some diversification benefits, but they don't look huge. I also didn't talk about risk. It's also possible that private equity has more risk, so I didn't correct for that either. So that's one rebuttal. They insisted that it should be MSCI World, at least for them. They said because MSCI World is a global index, and even our North America Blackstone private equity fund invests worldwide, and so we should be compared to MSCI World. Again, it means that you will need to have more detailed data on their track record to see exactly what fraction of their portfolio is where, and to try to like benchmark them within the subset. But again, they don't give all this data, and I don't know how many investors go into these details, but if they do, that's great. But that's what you will need to do. And again, it shows that you cannot conclude it was terrible, but you cannot conclude it was amazing either. Like you have too many data points you will need in order to be very assertive as to like what the performance relatively has been in the past. So they emphasize that LP seems to be very happy with the asset class. I have some explanation as to why they may think so, and some of it is about conflicted interests. Some other things are about them not understanding everything about IR and the like. So that's basically the main rebuttals.
Okay, thanks. So there are so many questions, and we only have a quarter left. So I'll just start and see where we get, and maybe we end 5 minutes later. Hopefully the people will stay. So here's the first question, more general question. So is there now an illiquidity premium by Chris Hitchen? which is entirely captured by GPs, or is there no such thing? A previous webinar presenter, David Beatty, suggested talented entrepreneurs prefer to run private companies because they can be more long-term and strategic than public companies, which have to answer to analysts and quarterly guidance and all that.
I believe in I wouldn't call it an illiquidity premium, but I believe it for some venture capital firms, because I believe a story that when you are an entrepreneur, if you have a great idea and you have a Sequoia that comes to you and say, I'm going to pay you half of what Ludo is offering you to get 20% stake in your company, you go with Sequoia. So there, I would believe that like, if you are like a really top venture capitalist, I believe it's plausible, the story that like you can capture a premium because people are willing to like leave money on the table for you. And perhaps Sequoia doesn't charge as much fees as they could, maybe. And so that some of it goes to their LPs. It's possible. I'm not sure exactly about the economics of that, why they wouldn't charge more, but maybe it is the case. In leverage buyouts, if you want an illiquidity premium, you need an imbalance between supply and demand. This is like Econ 101. If somebody is giving you a premium, if there is a rarity. So if you have people saying, I don't want to touch it because it's illiquid, then only the people that will walk in and say, okay, I take it, then they will be compensated. But I haven't met anyone telling me, I'm not touching it because it's illiquid. All I see is a wall of money going there. Nobody being very bothered about illiquidity. So if nobody is bothered about illiquidity, how do you get a premium appearing, right? You cannot have it, right? You can have it only if some people say, I don't want to touch this. So you have a supply and demand law, which seems to be a bit stubborn. And so that's the response about the liquidity premium. I don't know if it's exactly what you wanted to hear, but that's a remark about that.
So there's a question by someone called Andrew Rosenoff. I think he was in my board education program at ICPM. And he asked the question, if you were on the board of trustees of a large pension fund and were told by the asset owner that you must allocate to private equity, how would you go about it? Which approach would mitigate the problems you describe? So with all these facts you show.
Yeah. So it's the most difficult question, okay? This is the one I always try to avoid because it's easy to be an academic and say, look, I did the math. You have a table. This already takes a lot of time, okay? Like to get these numbers and like getting it right and seeing it's robust and like you haven't missed anything. So this already takes years, okay? Like to be sure about like these are the facts. I'm sure about that. It's not going to move if you change 1 year, if you do this or that. So I usually really try to leave it there, but I always get that question, like, okay, imagine you're me, okay, I have no choice, I have to do this, how do I do it? And the reason is I'm an academic is that I don't want to be in your shoes, I don't want to make these decisions.
You know what, we go to the question.
I'm going to do it anyway. So like I mentioned, there are some new models, there are some people trying innovative things. You have like people like Railpen in the UK, that are trying some innovative way to invest in private markets. The way I would approach that is educate your asset owner about these facts. Say, these are the facts. Once the asset owner understands these are the facts, then you can say, okay, what is it we want? If your asset owners is like, we want more exposure to emerging markets, well, then fine, we're going to go with private equity. Actually, in private equity in emerging markets, the interests are better aligned. Usually the fees are relatively lower given the cost of like deploying the strategies, etc. So, and there is no public markets. So yeah, private equity, let's do that. And let's just make sure we invest with people that have like good contracts and so on. And then, and we deploy in emerging markets, fine. If your asset owner says, I want to do like developed markets. Then you say, okay, so these are the facts. So what do we do now? We need to try to find better alignments of interest. Let's look at the subset of funds that are better aligned. Maybe like smaller funds are maybe a bit better aligned than the bigger funds. So some funds may have cleaner contracts than others. Let's look at that. Let's try to develop a direct investing program. Maybe we'll get people in-house to do more direct deals so that we avoid some of this financial intermediation. And maybe we hold assets for like 10 or 20 years instead of 4 years, and work with consultants maybe along the way. But if we hold them for 20 years, we're going to like absorb these big fixed transaction costs. And so it's going to be better than like going with these 4 years turnaround type of investments. So once you have the facts, there are all kinds of things you can come up with that are making a lot more sense, that you can see a bit like, what would work better, like in almost any scenario. In the US, there is a big company, for example, I think they are called PPC, that works with already like 30 pension funds, where basically the pension funds are owning the fund managers. These are ex-KKR people, interestingly. The pension funds are owning the private equity fund manager, and they write the budget. They agree on the budget. They say this is what it will cost you to deploy the money, etc. And the fund managers work with the budget given by pension funds. And then they take a carry calculated in a way that if relative to the right things, they outperform, then they take a take, they keep a take, and so on. So there are models out there. They are not developing very fast, but they could exist if people just started from these facts. Think about like long-term funds, like these long-term duration funds, like the one that BlackRock was trying to put together. You had the speaker on Tuesday of one of the people that was pushing this. If instead of marketing it the way they would market it this way, I think they would get a lot more traction. The problem is that they would upset a lot of people in the industry, but they would get a lot more traction. Because if you explain to people that this is the problem, and you come with a proposition of lower fees and much longer holding period of the assets, which is like their proposition, that like already is like squaring up. It's like, yes, if that's the problem in the past, then going forward, it will be more robust if we have a long duration fund with lower fees. And while at the moment, because they don't want to like push these facts to not upset the industry, then it's difficult for them to sell the long-term funds. So I think there are some solutions, there are some innovations, there are lots of people doing interesting things and exciting things. We should help them by just saying, here are the facts, and go ahead and double check. Go ahead and do the data work. And then say, okay, if I start from here, then I can help them. I think that's, and the SEC might help, maybe the regulator can help as well. But the industry could also get together and make a change.
Okay, so there are like tons of questions. Some of them are, can we see the recording of this? Yes, you can. So be relaxed. You will get an email.
I'm very transparent.
Yes. So the questions sort of go around 3-4 topics. One of them is just discussed. Can you also insource this, for instance? Could you do it in-house? But I think you already discussed that. Another one is, can you mimic private equity strategies by going public? I know you wrote a paper about that as well.
But I'm actually, so I need to disclose a scoop then, because I cannot lie. So then that's my problem in life in general. So I'm working on a product which I'm very excited about with a major bank to generate something that would be as close as possible to the private equity fund returns using public equity. And we are using very advanced machine learning techniques and text analysis techniques to create these mimicking portfolios. And I'm very excited about the project. I think it's like really awesome. And the first results that are coming in are really cool. We will not sell it, of course, because this bank needs to be polite with everyone. We will not sell it as this is to replace private equity. We will sell it as if you want to increase your allocation to private equity, and you are like under-invested and you have overcommitted and you're under-invested and you want to have like a plug-in type of product that very highly correlates with private equity, but is a liquid solution, then you could use that. If you wanted to short private equity, then you could use that, and so on. So an ETF return on this. So in a sense, the main competitors will be these listed private equity indices. I think there is a big problem with them, and I think we are solving it, and it's very exciting. But yeah, so I have that coming up.
So there's also a question on, you already referred in your talk to the fact that the US private equity is mainly US based. So even European investors invest a lot into US private equity. So if you compare the returns, you have to be careful with doing that. So is there any evidence on European or Australian or Asian private equity? And yeah, if so, is that in line with the evidence here? Some of the questions are in that field. So maybe you can say something.
With like the UK, it's hard to tell. So UK would be the second largest market.
Mm-hmm.
I would have to do that study very carefully because, again, if you just do UK with FTSE 100, you have this thing that before the financial crisis, like before 2006 vintages, they are doing extremely well compared to FTSE 100. But FTSE 100, like all the other international indices, is value weighted, and all these large cap indices didn't do very well. The FTSE 250 doesn't seem to be a lot better. So I would have to like really think about like what would be a good benchmark in the UK. In the US, like Dimensional Fund Advisor, T. Rowe Price, and like the S&P 600 index. You have a number of things that are like good proxies for like small cap, mid cap, and they are small cap and mid cap traded in the US. In the UK, I'm not quite sure what would be like a good index for that. And the rest of Europe, if you look like Euro Stoxx 50, but again, then you're just looking at a few large cap European as a benchmark. So it's not really a good comparable, right? If you use Euro Stoxx 50 in Europe, you are comparing effectively private equity, which is really small companies in relation to Heineken, ABN AMRO. This is what is in the Euro Stoxx 50. It's like big oil companies. It has nothing to do with what like private equity invest into. And so I would have to find really an index in Europe where I would be comfortable saying in the mid cap, small cap, that's a good index or that's a good mutual fund, but I could compare to European private equity. When you just compare European private equity to Euro Stoxx 50, I think Tim Jenkinson did that and he found that it was better. So private equity was better. Same in the UK. Rest of the world, you will get to very small number of funds and very young funds. It will be very hard to tell. But the general rule of thumb is that in emerging markets, returns haven't been good. And that's why a number of investors say, I don't want to do private equity investing in any developing markets. And I've taken issues with that because if you really look at their returns, they're like 10, 11%. And like I just said, this is basically what also American private equity has done. The issue is that American private equity and also the UK ones can gain the IR and show IR to people. And when you are doing private equity in a small cap or emerging market, developing markets, you cannot gain your IR as easily. You will not get subscription lines to pump up your IR. You will not manage to exit winners very quickly in order to pump up your IR. There are tons of things you will not be able to do to pump up your IR. And so you end up with funds in emerging markets that have multiples of 1.5 and 11% IR, which are like correct numbers. They are the same as in the US, but they're not perceived the same way. And so there is a general perception that emerging market private equity hasn't done very well. I think, again, if one had all the data to look at that much more precisely, the picture wouldn't be quite like that, at least for what I've seen. But it would require a lot more data than what I've seen to really give a strong answer.
Yes, you already gave a lot of data on returns. So there are some questions about the IRR, so the internal rate of return of 26, for instance, for KKR, I think you mentioned, and the realized return that you come up with on average for everyone of 11%. What the attribution of this gap exactly is, people ask. And related to that, some questions on the risk that is involved. So you talk a lot about the returns, but what about the risk of these private equity investments?
Yes, because we don't know how to measure the risk. So intuitively, if you think that leveraged equity is a bit riskier, then it means that the required return should be higher. But some people think that, even though it's levered equity, there's quite a lot of protections and it's not that risky. And this crisis will say it also because there's a big downturn, but the government is stepping in, and they have lots of credit lines, and so maybe they will be safe. So maybe maybe that would be one of the tests this crisis to know whether it's really riskier or not. Although the governments will change quite a bit the outcome because they may save or not some companies. So that's for risk. And before that, you had mentioned.
The internal rate of return, 26.
What explains the gap is that the IR is very sensitive to your initial cash flows. So what happens in the case of KKR is that you would start with like the 1976 fund, 1980 fund, and these funds will do well. And then what it means is that these funds will really have 25% return, okay? And what happens then is that IR makes the assumption that this money gets reinvested forever at 25% return. And so it assumes that there is this money, all these dividends being paid have been reinvested in this fictitious account and has grown to like balloon to like such a huge amount. But no matter what KKR does next, doesn't affect their return. So this is the intuition for why IR doesn't move after like 10 years and is very sensitive to initial cash flows. So imagine a world where you have 100 investors who tried private equity, half of them succeeded and half of them didn't. The half of them who didn't work out the market, the ones who succeeded and start with a good track record, as long as they don't have a major screw up later on, their IR is set for life. And so this is what explains the gap, is this reinvestment assumption of VIR, which is really, really bad. And this is also why people are using subscription lines and things like that in order to make the initial cash flows very positive compared to the initial negative cash flows, in order to set up VIR to a high level that will then not change.
Yes. So it's 6 o'clock in Europe at least. I have a final question in the context also of pension funds. This is the ICPM webinar series. What would you like to be the reporting of pension funds about their own private equity investments? Is what you saw and what you presented in the presentation, is that what you want, or is it more? What exactly do you...
If already, I would love PMEs, okay? I would love all the PMEs with different benchmarks. Like, that would be great. PMEs by vintage year, aggregated across vintage years, different benchmarks, etc. That would be awesome, okay? But if at the minimum people could just tell me how much they gave and how much they got back, just that would be awesome, okay? So like when people say Yale is amazing at investing in private equity, just tell me, Yale, how much you gave and how much you got back. We don't know. And we say they're amazing. Maybe they are, but we don't know how much they gave, how much they got back. How can we judge anything? Same for like CPPIB, a lot of like these star Canadian pension funds. Just tell me how much you gave and how much you got back from private equity. I want to know that number. And if you can give me PMEs, it would be awesome. But if you could just tell me your multiple of money, we would already have made like one big step forward. And if you could keep track of fees and tell me how much fees you've paid for it, so that you keep these things in mind, then it would be already a pretty big deal.
Yeah. Okay. I think this is a great ending of a great presentation. Lots of food for thought. Without giving any investment advice, and a moderator being an academic with a bias to be an academic, the presenter being an academic, and lots of people that are listening are people from the actual industry, so they must have something to think over dinner, breakfast, or at night when they sleep, and only because of your presentation. So thank you very much, Ludovic. Can you please close your presentation? Then I will share my screen to end.
Now, stop sharing.
Yeah, so let me go quickly. Share. So I just wanted to say thank you to all of you. It was a great and vivid, not just presentation, but also the questions that have been asked by the audience, really a lot, both in the Q&A and in the chat function, so I had to juggle in between. I'm really sorry for those questions that were not asked because I just couldn't, given the number. Thank you all for coming, and please make sure that you come back to us because we have other webinars coming up. One on technology and investing. Ashby Monk has written a book about that, Technologized Investor. And we also have Laura Starks, Texas University, who is going to talk about institutional investors and climate risk. Totally different topics, but still interesting. With that, I close this webinar and thank Ludovic and the audience for your attention. Bye.
Thank you. Rob, if you don't mind, like saving the chat and the questions, because they are very interesting. So it would be great if you can save it.
I will. Let me just see.